So this was sent to him on an email, and he was asked to build a model on this one. So it says create a valuation model for Avenue Supermart, which is basically DMart, using the DCF model. Send back your completed model in about 1 hour 15 minutes, post which we will schedule an interview on the same. Some instruction was also given. Very little instruction was there, but whatever is there is on the screen for you. I have added a couple of points from my side because otherwise it would have been very difficult to understand. So please take 5 years of annual historical data. Only the income statement, balance sheet and cash flow, balance sheet and cash flows are not required. So only the income statement is required. Use company annual reports only. Forecast the data for next 5 years along with drivers where necessary. Take assumption as appropriate and be ready to defend your assumptions. Valuation must be done on EBITDA. You can start with EBITDA into 1 minus tax rate and go further to calculate the FCF. So, when you read the first couple of lines, you would see, okay, I have to do 5 years of historical, 5 years of forecast, and it asks you to finish it in 1 hour, 15 minutes. Definitely not possible. But it said that only income statement data is taken, and then it is saying that you can do valuation based on EBITDA. So you do not need to go into forecasting of the balance sheet or cash flows at all. For the forecast period, assume working capital changes to be 0. So that is also one more relief that is there. Add a sensitivity table with terminal growth rate and beta. Add sources wherever necessary and explain any anomaly in the valuation. So this is where, this is what is given to you. I would like to ask you guys, how would you go ahead and approach this one? Is there go to the DMart website and download the annual report? So we go to investor relation, DMart investor relation. You go to DMart investor relation and go to the download section. You have got the annual reports. Right, and quickly download all the annual reports. So this is the first one. This is number 2. Number 3. Number 4. And number 5. In fact, 4 will be good enough. Okay. So I will go ahead and save that somewhere. Let me just create a folder here and call it as DMart. Now I would want you to also do it parallelly with me. Otherwise, if you just look at it, there's not much of a use here. Okay. So save this. Similarly, again, desktop, DMart, save. Desktop, DMart, save. Okay, so we have saved the files that are required for the forecasting. Apart from that, we'll also need some more files that we will download as we require for them. So after you've downloaded the file, let's just quickly open up the first one. So the one that is the latest annual report, we are just quickly opening that. Obviously, it is 200, 300 pages, or maybe sometimes even bigger annual report. We don't have time to read everything. So we will directly go into the financial statement. And in this case, we will just look at the income statement and search for, let me see if, yeah, consolidated numbers 162. Okay, so here is the consolidated balance sheet, and below that we'll have the consolidated income statement. Okay, so you'll take the data from the income statement, and we will stick to just data up to the EBITDA level, right? Because that is where we will have to stop and forecast up to there only. So we will quickly copy this data. Um, One way of copying the data is if you press Alt. As soon as you press Alt um, on the PDF, you can then select columns, right? And we just require up to this point. We just require up to this point. So I will open an Excel sheet. And then paste it here. Okay. And then we also copy the numbers. This is for FY22. This is for 23. Okay. You still need to make some adjustments. Total income, expenses, expenses. Okay. Town, total income. We go down. And then this is negative. Employee expenses, finance cost, depreciation, other expenses, total expenses, profit before tax. So we've taken this data for 2 years. Let me just quickly do a formatting. We cannot do a lot of formatting because we don't have time for that. So we will just stick to very basic formatting. We'll just remove the grid lines. Format here with numbers. I like the comma format, so I will just do comma and then reduce one decimal place. We also will use freeze paints. Okay. And maybe one more line here. We can just remove this one. And we do what we say as the year. So this is 31st March 23. This is 1 year prior to that, 31st March 22. Right. We'll just format the cells here. A bit of formatting we will have to do. It's not that we can just leave without any formatting. So you can just do a custom format as MMM dash YY. Okay, so this is there. We will take data for other years and then we will make changes to that data as required. Now, if you observed, I have taken the data for 23 and 22 from the 23 annual report. So as a best practice, you should take the data from the latest available year. So the 22 data is also available in the 22 annual report, but we will not take it from there. We will take it from the 23 annual report, because there are times where it could be restated, and you should ideally take the restated numbers. Let's go to the next one, which is again about consolidate 157. Yeah, we will take here for 21 and see if there are differences. Ideally, revenue from operations, this will go down. Yes, employee benefit expenses. Yeah, we've got all these things. This is for March 21, and one more year back, 43. And finally, one more year. Sorry. Consolidated P&L 159. Now, luckily, this company, all the data is in the same format for all the years. Otherwise, there are times where it has where the company's data for the way they report would have changed, and that would then have to be taken care of. So this is the stuff that is there. Now from here, the company, if you look at here, has not reported the EBITDA, so we will need to calculate the EBITDA by ourselves here, right? So to calculate the EBITDA, revenue is there, right? We need the revenue. I will add a few items. We will have the costs there. So what costs are there? Employee cost, and then we have the uh, other expenses. We don't have to take the um, depreciation, because we need to calculate the EBITDA, and obviously finance cost and other income will be coming after the EBITDA. So we don't need them as well. So this is broadly what is there for us: revenue from operations, and then this is the other expenses that are there. Now, I typically like to have all my expenses as negative numbers, so that gives us a clear understanding of what the numbers are. So I will just put a -1, copy that, and then multiply all my expenses, Alt ESM, with that. Okay. So all my expenses are now multiplied by -1. If you see, is there, and now we can calculate quickly. We could have, a total of expenses. We can just say total operating expenses. right? And that could be just addition of these items. And then you could have EBITDA, which is revenue plus this. Yeah. And we should also go ahead and calculate the EBITDA margin. So so okay, I don't need these items currently. I'm just going to push them back. Okay, I would go back to this to the people. So we'll go ahead and forecast the cost now. So the revenue based on certain drivers. Now, for this to know, we need to understand what are the drivers that the company generally looks at when it is reporting. So what we would like to go and see from the company's investor relation page is to understand how the company generally looks at the financial results. So let's just look at the recent one and see if we can find out with something called as investor presentation or something. Okay, we've got something called as investor updates, and let's see. Okay, there is something called as presentation, analyst presentation. This is something that you can look at to understand what are the important or key factors that the company looks at. So you can just click on that and go down. Okay, so let's look at what factors the company is or what things company is reporting. One thing that it is reporting is the product categories. Three categories are given. We have been given how much they contribute to each. Then they have spoken about their growth over the last decade or so, from about 55 stores in 2011-12. It's gone to 324 stores currently. Yeah. We've got additions also as to how many stores were added in each of the in the last few years. We can have this data. This could be helpful for us. So we'll just copy or take this data down. Number of stores. Number of stores. So we need it from 19, 21, 38, 22, 21, 21, 38, 20, 38, 22, 50, and 40. That is number of stores added. And then we have total number of stores. So we have 176 at the end of 19. Then this plus this gives you 214. So that comes out to be 326, but it is not 326, 324, and you have got information about that. So two of the stores were converted to fulfillment centers. So it is, we can't do that, so we'll just do 234 here, right? You can write a note for yourself. Two stores converted to fulfillment centers. Okay. So number of stores is something that is there. Apart from that, they are now getting into operational and financial matrix that they will be talking about. Number of bills cut. So how many billing, how many people billed, or how many times the billing happened during the year. This data is in crores. So this could also be useful, but let's look at what else we have. Like for like growth. So basically, like for like growth is the growth of DMart, uh, basically of the last 24 months. So those DMart which have been in existence for at least 24 months, their growth compared to last year. So that is like for like growth that is given to us here, and it says 24 months. Retail business area that is there. So how much is the space that they occupy? Retail business area is given to us. This could also be useful. And revenue from sales per retail business area, that is also given to us. That could also be something that is useful, or that could be useful. Revenue from EBITDA margin that we have anyways calculated. Revenue we have. PAT margins not required. Yeah. So basically now we will need to quickly understand how do we go about forecasting the revenues. Mm, so what we will try and do, one way of forecasting is to understand how much bill cuts are there, and then how much bill cuts will grow, and what is the revenue per bill cut. But it is very difficult for a company like DMart, because there could be some people who are taking a bill for just 10 rupees, and then there are people who are buying for 10,000 rupees. If you find out an average, that does not make any sense. Average of 10,000 and 1,000 or 10 will not make any sense. So what we will try and do here is try and find out the revenue per sales, revenue per square feet, or revenue per retail sales area. So we will need the retail sales area. So we will sales. This is in million square feet, so you can have one more column here. Sorry. Okay. Oops. Okay, and we can say million SQFT. 5.9, 7.8, 5.9, 7.8, 8.8, 11.5, and then 13.4. Right. So this is approximately the area in terms of million square feet. Right. All the revenue data that we have taken, revenue data is all in crores, right? So we will need to, if we want to work with crores, we can just work with crores, or we can convert this data into millions, right? I will convert the data into million just by multiplying with 10. Okay. Okay, so this is the million. This is also in million now we have, and we can now calculate sales per square feet. Right now, this number could be slightly different from the company's reported numbers. We will also quickly jump and look at the company's reported numbers. Uh, so here you see the reported numbers, 35,000 FY19. For us, it is 33,000. Here it is 32, 879, 27, 27, and 31. 27, 26, and 31. So the recent year is slightly higher, the previous years are low. Now this is happening because the company has got a lot more data, and it would have taken data for the stores which would have opened in between the years. It would have taken it for the partial years. We are assuming that the stores are opened, or the stores are opened at the start of the year. You could also just make this slightly better. If you want, you can use the average. So average of these two numbers, and quickly do away with that. Okay. So we're taking average, assuming that the stores were added in between the year. Now, again, as I said, our numbers may not be matching with the numbers that is reported by the company. And I've also told you the reason. And this is the number that we will be looking at for forecasting going forward. Okay, now to forecast the revenue, we'll first forecast these parameters, what we call as drivers, right? And after we have forecasted those drivers, then we go ahead and forecast the revenue by multiplying them. Okay, so one more data point that we will require to forecast this is, area added during the year. Okay, so this is basically this minus this. Okay, and then this is also in million square feet. And then we also want to understand what is the size of each store that is available to us currently. So what we'll do is, what is the size of stores added, and this we will do in SQFT, square feet. Okay, so it is basically this into 10 power 6, because it is in millions, divided by number of stores added. So about every store that you are adding currently, you are the size of the store is in the range of about 45 to 50,000 or 55,000 square feet, right? On an average is what we are looking at. Historically, if you just quickly calculate, that could be slightly lower, because you see 5.9 million square feet for about 176 stores. So that's about 33,000. In the recent years, the size of the stores have gone up. Okay. Now the next thing that we need to do is forecast these parameters. And how do we forecast the parameters? The first thing that we need to forecast for years going forward is okay. So one of the things that we need to forecast is how many new stores will be added to the uh, to the company every year, right? That is what we need to first forecast. So how do we get this information? Because it was also mentioned in the document that we may have to justify justify our understanding, right? Our forecast. So one place that you can get an understanding of how the company expects the future addition to the stores is again in the analyst conference call transcript is there, right? Typically you will find that transcript, and in that transcript you can look at and see what the company is talking about. And here we have a transcript from one of the calls that is there, right? So we will just quickly look at this transcript and see if there is any information on the stores given to us. 50 stores, 40 stores. So there is somebody who's asking, my last question was to on the store opening. As you mentioned, you probably want to maintain a run rate of 40 stores a year. Given the opportunity size, I think you last mentioned more than 1,000 stores potential that you see. Is there any internal way you could accelerate this addition? And then the company is talking about my question, 40, huge effort on 40 stores per year. And that single point agenda. Okay, so we got one number, about 40 stores per year is what the company is broadly looking at. And if you look at the historical additions also, I think it is about that. Yeah, about, if you look at the average is about 37. So 40 stores could be good. We can just look at if there is more information there. 60 stores per annum. We are ready to open. We have that ability, but from a market standpoint, the real estate that pulls us back. Okay. uh, it says next year for sure it will not happen. What will not happen? But will we be able to target 60 at a run rate level every year from the market for the next 2 years? I really don't know. Next year for sure it will not be it will not happen. I will also category mention that we will not open 60 stores this year. Okay. So, so about 40 stores a year, that is an assumption that you can take, and your backing for this assumption is what the company is saying. Currently, you're not an expert in the industry. If you were an expert in the industry, then you would have put in your thought also before putting this 40. But currently, it's not there, so we just stick to 40 stores additions every year. And because it is our assumption, we're going to just make it red in color. So our store, last year's stores will be plus this 40 gives you the next year's stores, and this is the number of stores going forward for the next 5 years, right? We need to also understand how much will be the retail sales area that the company would be looking at from a standpoint. um, let's search if they've given any data on that, could be helpful. Nothing much that I can find. We don't have a lot of time to look at that. So what we will do is we will stick to about 45,000 square feet. Now, this is your assumption, and this is based on historical data, and you are being conservative. If you look at the last 4 or 5 years, it's been higher, right? About 50,000 square feet. But on a conservative side, you are saying it is 45,000 square feet. So your area that is there, the area additions would be basically the number of stores multiplied by the area per store, and then that will be divided by 10 power 6 to convert it into millions, right? So this is the amount of area that will be added, and then in terms of the retail sales area that is available, what was available and plus what is added. So you've got the retail sales area that is there. So now you've got how much area is there, and what is the um, uh, what do you say, the total number of square feet that are available in terms of sales. The next thing that you need to forecast the revenue is to go and forecast the sales per square feet. For this, we have not much to look at. We are just going to rely on year-on-year growth number. We are going to rely on the year-on-year growth number and see what it is, and based on that try and forecast. And is this divided by this minus 1? Yeah, not much, nothing much that you can look at, but what we should definitely look at is uh, year 21, right? The year ending March 21, and a large part of the year ending March 22 would have been affected by the COVID, right? And pre-COVID, you were about 36,000 per square feet, right? The sales was 36,000 per square feet, and in March 23, you've reached to 34,000 square feet. So gradually, you may increase to back to about 36,000 square feet, and we will just stick to that. So what we do is last year, whatever was the number plus a certain growth percentage. Okay, we'll put the percentage. Let's say it is about 5%, because again, you can't keep growing very fast, right? Because um, yeah, you already at 5%, you are already at 36,000, right? So then we can just say a 3%. Yeah, 3%, 2%, and then 2%. Yeah, you can still continue saying that the sales per square feet will also grow at 5% for all the year, but that will be slightly on the aggressive side. So now we've got that. Now we are going to just calculate the revenue. So we know how much is the retail area and how much is the sales per square feet, right? Retail area multiplied by sales per square feet, that gets you the revenue. That gets you the revenue. So we've got drivers for the revenue, and for any model, the revenue drivers are quite important, or the most important. If we had time, we would have done much more than this, looked at more data point, but this is what we can currently do. Once this is done, then we need to forecast the cost. Now, in case of cost, what we are going to do is not forecast the cost, each of these costs separately, but we are going to forecast the margins. Typically in such business, the companies try and manage the margin, right? You would have seen even in the COVID period, they have tried to manage the margin, even though it's fallen in March 21, but they try and maintain in a particular range. So we will keep it in the 8.5% range. We will actually stick to 8.5%. We just say 8.5%. These are our assumption. Make it red in color. These were also our assumptions. Make it red in color. Yeah. and then we now know how much is the revenue multiplied by the margin gives you the EBITDA. And then you can reverse calculate the operating expenses as EBITDA minus the revenue. So we have forecasted the EBITDA for the next 5 years, and this is what the model had asked us to do, to forecast the EBITDA, and then from EBITDA get to the valuation. So I don't require these numbers. I'm just going to remove them from here, or maybe I will just keep them if I require at some point. And then directly jump into the valuation. Now it said that you can start with something called EBITDA into 1 minus tax rate, right? It is something like NOPAT. NOPAT is typically EBIT into 1 minus tax rate, but we are doing EBITDA into 1 minus tax rate. EBITDA into 1 minus tax rate. Now, for this to do, we will also have to understand what would be the tax rate, right? So we need to forecast a particular tax rate. I will just do it here, right? And let's just quickly see if we can find the effective tax rate. Yeah, profit before tax is there. And then we can also add for a couple of years. Tax expenses, just to quickly check what is that number. About 20 to 23%. We should ideally do it for multiple years. We can also take it for one more year, maybe. Yeah, 27%. So we will just do about 25%. That's the statutory tax rate currently applicable. So we will stick to 25%. I'm going to take up the questions towards the end of this. 25%. So we can just do EBITDA into 1 minus, as I said, ideally you would have done EBIT into 1 minus tax rate, because it was mentioned we are doing EBITDA minus 1 tax rate. To this, obviously you will, if you had started with EBIT, you would have added depreciation, but we have started with EBITDA, so we don't have to add back depreciation. The next thing that we have to do is less capital expenditure, CAPEX. Then working capital changes, is said that there is no working capital changes. So we will just keep changes in working capital. Uh, and then put that 0 for the time being, because that's what was mentioned. Now we need to forecast the capex. While nothing was mentioned for the capex here, you could take two stands. One saying that nothing was mentioned, so I will not do it. But I would, kind of not take that stand, and I would quickly go to the cash flow statement that is available for the previous year, right? For the year 22-23, and see how much is the outflow related to the capex. Quickly see that and see if I can just make some judgment from there. Yeah, purchase of property, plant, equipment. If you see, it's there for 2 years. We have this data. We can see it for more. So 2000, 2100. 1700. So between 2200 to 2400 something. So we will just take minus 22,000. Okay, 22,000 because it is in crores. We are doing here in millions. So, and minus because it is outflow. So this then gives us something called as FCFF, free cash flow to the firm. And you can just total it up here. Free cash flow to the firm. So we've got the free cash flow. To do the valuation, DCF valuation, we need to discount this free cash flow using the weighted average cost of capital. So the next thing that we need to calculate is the weighted average cost of capital. So let's do some calculations here for weighted average cost of capital. So to do the weighted average cost of capital, first we need to get the weight of equity and weight of debt, right? So let's get to that. So to get the weight of equity, first we need the share price. Share price, then number of shares, equity value, right? Then we need debt, then we need cash, then we'll get net debt. Finally, you will get the uh, total capital. Some people use the gross debt, they don't do the net debt. Some people do net debt. We will stick to net debt. So to get the equity value, first we need to get the share price. So current share price, you can actually the newer version of Excel allows you to get the stock price. You can get the stock price. We can just share price. So the you can use this to get the share price. Why am I doing this? Okay, and then you can just click on this one, stock. Yeah, so it will identify, and then it also has this. So you can just quickly get this data from here. We could have taken the market cap directly, but we'll take the price. So here it is a formula which is coming from here and there, and it will keep updating itself, so you don't need to be worried about that. So whenever the data is changing, it will get changed. So you've put that number of shares. We will also use the same here to get the number of shares. So it also has that option to get the number of shares outstanding. Yeah, now so the value of equity is this into this. I need to still understand. Okay, this is the number of shares and I need to divide it by million because everything is being done in millions. Power 6. So that is the equity value millions. Okay. Uh, Debt, value of debt. So we will quickly look for on the balance sheet the debt. We just look for the current year. That's what we are looking out for. And okay, we've got lease liability. Don't see any other debt that is there. So we've got short term and long term. We will take both of them as debt. Yeah, different people may treat it differently, but we are going to take it as debt. And then needs to be converted into million. Similarly, we have another one. So this is the debt. The cash and cash equivalent also we have here. We are going to take this cash and cash equivalent. 07.15. 2071.5. Right? With a minus sign. So net debt is this plus this. And then total capital is this plus this. So um, weight of equity is equal to value of equity by total capital, almost 100% equity. And then weight of debt is 1 minus this number. Alternatively, you could have divided this number by the total. So weight of equity and weight of debt is there. Now, apart from this, we need also things like cost of equity. So cost of equity is basically risk-free rate. Right? Then we need beta. And then risk premium. Right? So to get to the cost of equity. Right? So we could also calculate the cost of debt. We will calculate the effective cost of debt quickly here. How much is the interest expense? Interest expense is 67. and approximately, okay, we're not trying to get about 10%. So we already know the cost of debt is about 10%. You can put this as an assumption, and then later on you can say that, okay, I took this assumption based on this understanding. Okay. Cost of equity, for that we need to get the risk-free rate. So risk-free rate is basically 10-year government bond yield, right? So year bond yield India, 7.15. 7.5. Okay. 7.15. Beta, we will quickly search for beta. Now you can use Mr. Damodaran's yeah. So what you can say is beta Ashwath Damodaran. He is giving beta for various industries. You can use that. So it is retail. Yeah, we will put this into retail, grocery, and food. And the beta, we'll use the unlevered beta. So it is this column. So general food, zero point 0.5. Yeah, 0 0.5. You can also search for separately for beta for DMart. You can use that. Okay, let me actually show you that as well. Beta for D says 1.4. Looks very high. Okay. So we'll use this one maybe. You can just put this. Generally, when we are working in actual equity research, we tend to go for Bloomberg. Okay, we use this one. Let's use this one. Yeah, this is already levered beta, so we need not be worried about unlevering and levering. Also, the long-term return from the market. Let me not call it as risk or long-term return from the market is about 12% or 12 to 14%. So 14% minus this. So that is your market risk premium, and cost of equity then becomes RF plus beta times RM minus RF, which is the risk premium. Yeah, cost of debt is this, and then we can also find WACC, weighted average cost of capital. It is weight of equity into cost of equity plus weight of debt into cost of debt into 1 minus tax rate. I will put the tax rate here, so I will just link it to this one. tax rate 25%. Yeah. Okay, now we forecasted it for 5 years. We also need to look at a terminal value. So we will calculate the terminal value also here. Terminal value. Various ways of calculating terminal value, but we'll be using um, the present value of a growing perpetuity. So for that, we need something called as the terminal growth rate. Terminal growth rate, we will put it around 3.5%. So is this into 1 plus divided by WACC minus growth rate. Okay, present value of a growing perpetuity. Present value of a growing perpetuity. And then we can get the total, yeah, which is basically summation of these two numbers. When we discount this using the weighted average cost of capital, we'll get something called as the enterprise value, right? So enterprise value is, you can use the NPV function, the rate, which is your weighted average cost of capital, comma, the cash flows. So this is your enterprise value, right? This is your enterprise value. And then from this, you will deduct net debt less net debt, which is here. So what you get is called as equity value. And that is divided by the number of shares. Number of we already have the number of shares here, and then you will get the share price, right? So this data is all in millions, right? So this needs to be also converted into million. So okay, so what you get is a current share price or your target price, whatever you call it. Let me just do it here only instead of complicating. Yes. So you see here, one of the things that you will see here is that the current share price is 3,000 something or almost 4,000, and we are saying that the target price should be 400, right? Should be 400. Now, why this anomaly? This anomaly is coming because the DCF, one of the places where DCF fails is when you have a situation where the company is growing very fast, right? If you see what we had assumed in this particular model, that the terminal growth rate would be about 3.5%. If you see currently, the company is growing much faster than that, right? So the growth rate will not suddenly fall to 3.5%, but it will slowly gradually reach to 3.5%. But what we did is we forecasted for 3 years, and after that we are saying that it will fall by it will just grow by 3.5%. If you see the growth rate here of the FCFF, you see the FCFF is growing quite fast, right? It is nowhere. The average for the last few years, last 3-4 years, is 27. If you just find out the CAGR also, we can just quickly find out the CAGR. Right? So compounded annual growth rate of 13% here. Um, Compounded annual growth rate of yeah, and you see the growth rate for each of the year is okay. I used a different number. That is why. So this is this divided by this power 1/4 minus 1. Right? So the CAGR is 27.5, right? We calculated the CAGR. It is different from the normal average. Uh, so the CAGR is 27.5, and what we are saying is suddenly when it is growing at more than 20%, suddenly the growth rate will fall to the 3.5%, right? But that is not true, and that is one of the drawbacks for DCF. If you have got a company which is growing very fast, then the DCF model will not take care of it, because it suddenly says that the terminal growth rate will come down. We cannot take a terminal growth rate of, let's say, 5%, 7%, or 10%, because that's not going to be there in the future. What is the alternative here? What you can do is forecast for another 5 to 10 years, or maybe 15 years also, and then slowly taper it down to that. And if you do that, then you could get closer to that 4,000 numbers, right? But this is the potentially this is the anomaly that was being spoken in the question, because if you see, the question said that explain any anomaly in the valuation. So this is something that you could explain, saying that okay, this is happening because of this reason.